Bitcoin is not. It's near 52-week lows. Well, okay, then is it the digital gold? Well, gold's at all-time highs. Bitcoin is not. It's near 52-week lows. Bitcoin is at an existential crossroads. It needs to figure itself out, because then what is it? And the reason this has to be, and there's a lot of Bitcoiners out there, hodlers out there that are going to say, oh, well, it's a little bit of this, a little bit of that. But when you're talking to the masses out there, the people that are buying in their ETFs, the ETF in their portfolios, they need to know. Pension funds need to know, right? Is it a way to protect capital, or is it a risk asset?
Bitcoin is currently facing its most significant identity crisis in its 17-year history. For years, the hodlers have argued that Bitcoin is both a high-growth risk asset and the ultimate digital gold. But in the first half of 2026, the data is telling a conflicting story. If Bitcoin is a risk asset, why is the S&P 500 hitting all-time highs while Bitcoin languishes near its 52-week lows? And if it is truly digital gold, why is physical gold ripping to new records while Bitcoin breaks down through technical support? If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Almost everyone watching this video is going to agree with that. It's unsustainable. And it's probably one of the reasons, maybe the main reason, why the metals are ripping like they are, specifically gold. And ultimately, we came into the year 2025 thinking there were going to be major fiscal responsibility things put into place. Doge was brought into play with Elon Musk, and we don't even see it anymore. It's not even in existence. They actually dissolved it. And now we see the government spending more money than ever before. And so this is the issue here, right? There's this fundamental fear amongst everyone, you, myself, and everyone watching, that this is an unsustainable path, and us as Americans, us as global participants, we have to start to prepare. And how else to prepare but buy alternatives to the US dollar if this is the trajectory we're on. I am a believer in Bitcoin, but Bitcoin right now, right, you would say, okay, well, is it a risk asset? Well, the stock market's at all-time highs. Bitcoin is not. It's near 52-week lows. Well, okay, then is it the digital gold? Well, gold's at all-time highs. Bitcoin is not. It's near 52-week lows. Bitcoin is at an existential crossroads. It needs to figure itself out, because then what is it? And the reason this has to be, and there's a lot of Bitcoiners out there, hodlers out there that are going to say, oh, well, it's a little bit of this, a little bit of that. But when you're talking to the masses out there, the people that are buying in their ETFs, the ETF in their portfolios, they need to know. Pension funds need to know, right? Is it a way to protect capital, or is it a risk asset? And without that, you're not going to get the next wave of buyers. And so we have to figure this out as people that believe in Bitcoin, to figure out what it is, and it has to start behaving like that. Just because it's gone up so much, it generally, because things are fundamentally shifting in the global sphere and in the US, it's probably not going to parabolically drop as much, but you will have a flush out. That's what we know from technical analysis. Now, the bigger question is where, right? I would have thought it would have been this pierce of $5,000 per ounce. We have not seen that yet. Now, what we can do is go to the logarithmic chart and start to take a look here and see. So I flipped it to the logarithmic chart, and we go back here. And what we do is, if we flip over to a larger time frame, we start to notice that, again, you've had this incredible move in the 1970s into 1980, this long base, another incredible move here, and a consolidation base that was shorter. And by the way, think about this. So, and this is just a little side note, but it's fascinating. Look at how long the consolidation base was here, and look at how long the consolidation base was here. Much shorter in the 2010 to 20 range. Now, why? Ask yourself why. Because here, this is where we actually had fiscal responsibility. We actually had a balanced budget at one point. Here, no balanced budget. And the problem is these down cycles in gold, if we continue on this trajectory, are going to get shorter and shorter. So wherever gold tops, and I'm not going to pretend I know at this point, it's going to be a much shorter bear period or consolidation period unless the fiscal restraint is restored. And that's really the key crux here, folks. I mean, it just comes down to people rushing to diversify to protect themselves. They're buying insurance on a sinking ship. We see the ship sinking. We've got to buy insurance. And so what I would expect is, if we see a sudden drop, a sharper breakdown in the dollar, the fear, just if we all remember what happened in COVID, right? When COVID, March of 2020, occurred, we saw the stock market decline and gold also fell initially. And that would be my expectation. So basically, the idea is that fear permeates all. And when people get very scared, they sell everything to be safe. And then once the dust settles, they say, all right, let me start buying gold again. Because again, this is a bullish sign. So again, fear triggers the sell. And then very quickly, we saw gold and COVID recover and actually move up substantially. I would expect the same thing. So initially, I think they fall together. Maybe that's where the correction comes in. When the stock market corrects, gold corrects as well. And then I think gold, after a quick correction, starts to regain and move higher.
Okay. Key levels for the S&P 500 at this point. We're almost at 7,000. What's next?
Yeah, so what I'm really watching is these two trend lines, right? We have the bigger parallel here going back to 2020 and this one from April of 2025. And you can see how it basically tagged each of these lows right through here before we broke down. Watch this zone right up here, basically between 7,015 and 7,050. If the S&P can get above that, you now are in price discovery mode. And we could see something a la a move like we've seen in gold to the upside. If it gets rejected and we can't get above here, at some point, path of least resistance is a much bigger move down. So really, we look at the mega caps reporting, we look at all these factors coming in, inflation data is coming in the next few days. Watch closely to see, can the S&P get through this level? If it does, bulls continue to rule the roost. But if we can't get through this level in the next 2 weeks, I think you're looking at a 15-20% drawdown in the stock market.
Okay. That brings down Bitcoin with it, or no?
Yes, unfortunately, yes. Bitcoin is again, has performed horribly. Look at this trend line right here on Bitcoin. It's even broken short-term technical support. Today, we saw, again, a rally on Bitcoin to the underbelly of this trend line, and it got rejected, is now flat on the day. But this, again, is what we would refer to in technical analysis. This was a bear flag, right? A move down with a lot of sideways chop. And now it's potentially broken. As if it can't recapture 90,000, this is going down to 70,000.
If the dollar breaks below its current support, there is nothing to stop it from falling into the low 70s. This is a boiling water scenario for the American consumer. A weaker dollar means we are importing inflation. When the dollar drops, the cost of everything we import, from electronics to live cattle, soars. We are already seeing copper, silver, and platinum near all-time highs. This bubbling up inflation is the true wild card for 2026. While Jerome Powell claims the economy is hanging in there, the charts of the DXY suggest a currency crisis is brewing that could catch the entire market by surprise.
Signal there or there, but right now, I don't see it myself. I thought the Pursa 5,000, 5,100 would have been a little bit of that reversal. And then what we've seen here just in the last few days is more tariff threats come out, the Federal Reserve coming out with their statement. And all that's happening is people saying, wow, I believe in the U.S. financial system less and less. And they're buying more and more. Now, again, there will be a reversion on this trade. My guess is, and it's hard to know the top, but my guess is when we look at the reversion here, and let's take it off the logarithmic chart, is what we'll start to see is a retrace to a reasonable pullback level. Like right here, we could see on the move up, this is where we stalled out, which means when we do correct, this 4,300 likely becomes your next base point, right? That's where you're going to hold on to the major gains, most likely, and potentially turn up unless we see that fiscal responsibility built in. Now, David, you remember in I think it was 2013 or 2012, the countries like Italy, Greece, remember the market eventually imposes austerity by certain means. And I do think the U.S. is going to face that within multiple years, maybe within 3 years. The markets themselves will start to impose austerity regardless of whether our political players do.
Hold on. What do you mean by austerity? Who's going to impose austerity?
So for instance, who's going to control the long end of the yield curve, right? If we look at the 10-year yield, the 10-year yield has just broken out. Look at this. We had major resistance all along this area right in here, and we kept on hitting it. Then we bull flagged, and we broke out. Now it's beginning to move up. And so my point is, austerity is put into place by interest rates, right? When you have the long end, which can't be controlled by the Federal Reserve, and those interest rates start going up, it's literally going to make it so we are going to have to cut spending and get our fiscal house in order. And really, the rest of the world at some point will force us to as well by not buying our debt. Gold is obviously harder to pinpoint, and I'm a big holder of long-term gold. I've been a big holder for years. In fact, I think a couple years ago it was my top pick with you on your show at the end of the year for performance back, I think it was 2022 or 2023. But ultimately, again, the excitement around it has made it an overcrowded trade. A lot of what we call in the trading world is the weak hands. The weak hands are the ones that buy in late and then they expect to get rich quick. And again, you compare that to those of us that have held gold since 2015 or 2010 or 2019, where we were just like sitting there watching everything else go up. And we're like, but we really understand the financial reason for holding gold here. And now we're getting the payout, right? But those players that buy late that are doing it to get rich, those will be the ones that get flushed out. The rest will it'll then start to head back higher and probably make new all-time highs. I still think it's going to 10,000. The question is in what year?
Okay. What does the world look like at 10,000 gold?
Oh, man, the hard questions. You're bringing your A game today. At 10,000 in gold, I would assume we are at a whole new scenario of dollar or de-dollarization. I would think, and I think honestly, that's a big thing of what's going on right now. If we look at the US dollar, we've just seen one of the biggest drops. In fact, the biggest drop in the DXY since the tariffs were levied last March or April in a 7-day span, right? So 7 days down like this. Now, part of this is intervention with Japan, right? We're trying to prop up there, and you played that clip from the FOMC press conference. But at the same time, you are at a pivotal road. Look at this on the DXY. This is scary, folks. So this is your financial crisis low on the dollar, just as we were getting into the heat of the financial crisis. This was June 2008. And look at this zone of support. The dollar has been riding up. Now, we've heard about de-dollarization for ages, but until this breaks, I'm not a real believer, but it's looking like it's getting ready to break. And once this breaks, there's probably no stopping the US dollar from depreciating maybe as low as the financial crisis lows, back to the low 70s on the DXY. And that's a scary scenario because remember, this is going to import inflation, folks. A weaker dollar, when we import so much of our goods, it is going to bring inflation up. And then you look at copper, then you look at silver, palladium, platinum, all of these things, live cattle prices, all near all-time highs. Now, listen, grains are still low. I still actually like those as a defensive play, but there is bubbling up inflation. And I do think that's the kind of the scary part for 2026 that could surprise the market, right? The economy, we heard from Jerome Powell today, the economy's hanging in there. It's still looking a little bit better. But what about inflation? Because I look everywhere and I'm seeing inflation bubbling up, and I have a feeling everyone watching is seeing the same thing.
Okay. So once the dollar breaks down, what does that mean for, let's just take the S&P 500 in particular. Does this have any impact on the stock markets?
Yeah, so again, it's going to have a big impact if it's in free fall, right? So if we just inch down a little bit every month or so, it's going to have a very minimal impact. It's kind of like, what do they say? You put I won't even get into it, but something in hot water and you heat the water and it's heating slowly. They don't realize it, but if obviously boiling water is a different story. But the idea here again is that the dollar, if it starts to break down significantly below the level we just discussed, is going to bring this market in because, again, we are so reliant on the world buying our debt, right? And the dollar being the reserve currency, it is going to shake the fundamentals here. And you can see here on the S&P, let's go over this, right? So this is what's concerning me. Everyone, listen, what I think is so interesting is so many individual investors were coming to you and asking you, is the market topping? I don't know if they were talking about gold and silver or if the stock market, but in relation to the stock market, this is what's concerning. Look at where we are on this parallel. Here's your COVID low. Here's your bear market low. Here's your liberation sell-off low, right? Then you have your highs here. Perfect parallel. Look at where we are. In fact, the last time we touched it was in October. And we're now at a point, look at this trend line. Here's your liberation sell-off low. We drag it right up. We've broken this trend line. And going into today, we are now basically at the underbelly of resistance or dual resistance trend lines. Now you look at after hours, right? We look at Microsoft down on earnings. We look at Meta. Meta's up on earnings just a little bit. Let's see where Tesla's moving up. So this is going to be interesting tomorrow to see who has more power here to keep the S&P rolling higher or starting to bring it down. But again, Microsoft seeing some sell-off in the markets in the after hours here.
The path of least resistance for the dollar is down, and for inflation, it is up. In this environment, Soloway looks to defensive plays like grains and long-term gold holdings that were established before the crowd arrived. The ship is sinking, and the insurance you buy today will determine your survival tomorrow. Whether you are watching for the $10,000 gold target or the 7,000 S&P breakout, remember, the charts don't lie, even when the politicians do. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.